Hi, I'm Ken Leon, Director of Equity Research, here to talk about Netflix ad-paying launch matters. Netflix is the market leader in video streaming. It's been principally ad-free subscriber plans, and all eyes are on the November launch of its ad-paying plans, which has potential upside for revenues, but there also are risks. When we look at video streaming, the key business drivers would be the secular substitution to streaming from linear networks, pay TV and broadcasts. And this has been a multi-year phenomena that we will highlight. But it's also a crowded field where the video on demand providers have many offerings to households, and there might be exhaustion out there, or perhaps when you add up at the end of the year how much you're paying, there might be some cutbacks by the customer. We think what's overlooked possibly by the more bullish analysts on Netflix is that we're likely to be in a US and global recession in 2023. This will impact consumer confidence and lifestyles, and of course, any pain points with unemployment or high inflation is going to tighten household purse strings. Competition is an increasing risk for Netflix. We're talking about formidable competitors in the video streaming area, whether it be Disney Plus with Hulu, Amazon Prime Video, Discovery Plus, HBO Max, Paramount Plus, and there are others. So competition is not going to make life easy for Netflix, whether we are talking about ad-free or ad-paying plans. So the milestones and benchmarks we think are important for Netflix. And historically, it's been subscriber growth. They have 220 million subscribers. So this is not a small, nascent, fast grower. And we have seen maturity in the US and Canada, as well as in Europe, not as much in Latin America or Asia Pacific, but those markets we would emphasize the rate plans are significantly lower than the monthly charge in the developed markets. So the wrinkle of the new advertising revenue becomes really the key driver for anyone that's bullish on the fundamentals. And we think the benchmark is going to be evaluating EBITDA, profitability, and free cash flow, which have been weak in the last 1 to 2 quarters. Here's an illustration of the secular trend. This is just looking at the last 12 months, and you can see that streaming has now taken over from cable in terms of the number of viewing hours. So the average monthly revenue per paying member really matters. And we think with the 2023 scenario of recession, we think analysts might be too optimistic to possibly seeing these rates come under some pressure or with greater incentives. Europe is very likely to go into severe recession next year, and we think there will be effects of global recession both in Asia Pacific and Latin America. But you can see really the variety of rate plans, with the US or UCAN being the largest and the emerging markets much lower. Netflix at this stage may not be a growth company anymore. Here is a 5-year snapshot illustrative of Netflix subscription revenue. It's maturing as you look at subscriber revenue growth, 35 million in 2018. That revenue growth is now 8.6%. Advertising revenue, so we begin to see numbers come in here for advertising. We're talking possibly $1 to $2 billion 2 years out. There's some kind of behind the scenes view that Microsoft, which is Netflix advertising platform partner, might be guaranteeing $500 million to $1 billion. And of course, All this, to my point about EBITDA, is important because you can see that EBITDA growth, which was 85% just back in 2018, was a minus 12% in the second quarter on the year over year. So each of these becomes important from the advertising as a new source of revenue. 5-year snapshot. Netflix, no question, is an established media company. They are a pure play on streaming. They have built up a substantial studio programming and content that has had an effect on margins and profitability. But this is a large company today. You can see that the total debt to total capital ratio has come down from nearly 66% to 47%. And again, looking at this company, it has the fair financial wherewithal to be successful. We just don't think it's a growth company anymore. And I think with recession next year, it's likely that it's going to have effects on subscriber turnover, which is critical for driving revenue and EBITDA. So what can go wrong? We have a sell rating on Netflix. We're kind of in the minority. Many analysts are bullish on this new advertising revenue being really the savior for Netflix and becoming a growth company. Where can we be wrong with our thesis? Clearly, if we don't see recession but economic expansion, we gave you a lineup of formidable competitors. Perhaps there's less competition in global streaming. Maybe this is some of Netflix competitors that cut back on programming and production. Lower programming and production costs for Netflix could definitely lift EBITDA. And I think the big wild card is that, even, when you have a great offering, either in TV episodes or movie, you get binge watching and very high churn when it's over. Very different than my experience in covering wireless or what we've seen with cable TV decades ago. So obviously significant advertising revenue that gets to the numbers I talked about, $1 to $2 billion in a hurry in 2023 would obviously be positive and not really part of our sell rating. So there you have it. Really, to get more of our views on Netflix and video streaming, you can go to Market Scope Advisor. If you go to Thematic Research tab and then to Communication Services, you can get to the 2 thematic reports that we publish on Netflix October 6th, and then also video streaming, Navigating Choppy Waters, published on August 15th. Thank you.